Imagine you deposit $1,000 into your bank account. You might think the bank keeps all that money safe, ready for withdrawal. In reality, banks operate on a system called fractional reserve banking. This means they only keep a fraction of your deposit, say 10% in reserve, and lend out the remaining 90%. So, from your $1,000, the bank holds onto $100 and lends out $900 to someone else. That $900 can then be deposited into another bank which keeps 10%, which is $90, and lends out $810, and so on. This cycle continues, effectively multiplying the initial deposit across the banking system. This process is known as the money multiplier effect. The total amount of money that can be created is determined by the reserve ratio. The formula is simple. It's 1 divided by the reserve ratio. So, if the reserve ratio is 10%, that's 0.10. Now we do the math. 1 divided by 0.10 equals to 10. This means your initial 1,000 deposit can potentially lead to 10,000 in total money supply through successive lending. While this might sound like financial wizardry, it's a fundamental mechanism that fuels economic growth. By lending out money, banks enable individuals to buy homes, start businesses, and invest in education. However, this system also means that the majority of money in circulation isn't physical cash, but digital entries in bank accounts. In fact, in many economies, physical currency makes up only a small fraction of the total money supply. The rest exists digitally, created through the lending activities of banks. Fractional reserve banking isn't without its risks. If too many people decide to withdraw their money simultaneously, a situation known as a bank run, banks might not have enough reserves to cover all withdrawals. This can lead to financial instability. Moreover, critics argue that this system can lead to excessive money creation, contributing to inflation and asset bubbles. The 2008 financial crisis highlighted some of these vulnerabilities, prompting debates about banking regulations and reserve requirements. To mitigate these risks, central banks and regulatory bodies impose certain rules. Rule number 1: Reserve requirements. Banks must hold a minimum percentage of deposits as reserves. Rule number 2: Deposit insurance, which protects depositors' funds up to a certain limit. Rule number 3: Capital adequacy ratios, which ensures banks have enough capital to absorb losses. These measures aim to maintain trust in the banking system and prevent financial crisis. Central banks like the Federal Reserve in the United States play a very crucial role in controlling the money supply. They use tools like open market operations, which is buying or selling government securities to influence liquidity. Number 2, discount rates, setting interest rates for lending to commercial banks. Number 3, reserve requirements, whereby they adjust the percentage of reserves that banks must hold. By manipulating these tools, central banks aim to maintain economic stability and control inflation. Thank you for watching.